Hi there. Welcome to another episode of Investment Insight presented by McCay Wealth Advisory. I'm Bradley Covert, sitting down today with Brent McCay. Brent, we've seen a lot of volatility going on in the market right now. Can you talk to us a little bit about how we should handle that as investors?
Right. So volatility is very normal. We normally see 10% drop a year, 5% drops a year. Recently we've seen closer to that, almost that 20% bear market drop, and we may be there when this video comes out. One of the biggest things you can do with the portfolio is making sure that your investments are appropriately set up for your risk level. Anytime you see a big drop or a drop, you need to look at and review your investments and say, hey, am I in the appropriate amount of risk? Am I going to stick with the plan when I lose this much money? Because if you're not, you're probably not in the right risk level. That doesn't mean it's time to sell. It means it's time to review and look at how your money's invested and build a game plan going forward. The next part of that about investment is have a truly diversified set of investments. If you've got 3 S&P 500 funds in your portfolio, they might have different names, but they're the same thing. So you're really not diversified. We've seen recently a lot of companies are very heavy, or a lot of people investments are very heavy in technology companies. And those technology companies have done very well in the last couple of years, but when you've done well, you probably need to diversify that out into some lower risk investments before a drop occurs. Because when you see a drop, what did really well the last couple of years is, in my experience, more likely to drop more than other types of investments. And then the biggest thing too is when you look at retirement, make sure you've got a portion of your portfolio that's in lower risk that you can live off of if the stock market's down or the bond market's down. You need to have that portfolio set up to where you can live off that until things get better. And you need typically 8 to 10 years of that in something that is lower risk. And so that way you can wait it out. And remember that in your portfolio, because it's not just the bottom line total number. It's how are those low risk assets doing? And we'd love to build a plan for anybody. We don't charge any cost for that currently, to build a plan, see if you're in the appropriate risk level, if you've got the right funds for recovery, and then to be looking at, hey, I want to be a buyer when the market goes down. I want to use some of that safe money if there is a low, and I want to buy some investments that are cheap so that when this thing recovers, I'm not back where I started, I've actually made some money.
Right. Brent, thanks for talking to us a little bit about that. Thank you for joining us. We'll see you next time.